My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends, just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Welcome to the twilight of the index funds. I think that's the great untold story of this market. It played out again today as the Dow lost 445 points. The S&P fell 2.21%. NASDAQ declined 1.44%. For years, lots of very smart people, graybeards, told us that index funds were really the best, if not only, way to invest. Instead of trying to beat the market, they argue that you should just buy a cheap index fund that mirrors the market like the S&P 500. But sometimes trying to mirror the market is a bad strategy. Take the S&P 500. You have to own so many have-nots along with the haves during this pandemic. It's changed everything. That at best now, with the coronavirus, you're betting on mediocrity. Why would you want to own an index with lots of exposure to really troubled industries like oil and gas, travel and leisure, the financials, retail? Suddenly, stock picking seems a lot more appealing. I know the index fund orthodoxy will never truly be defeated. There's a kernel of truth in it. For many people who don't have the time or the inclination or do their own homework or can't own individual stocks like me, index funds will always be the best way to invest. But man, in this environment where you can't go out and spend money without fear, even if you just got a $1,200 check from the government, it's nuts to own all 500 stocks in the S&P. You don't have to be a genius to know that the cruise lines here are, let's say, untouchable. What about the winners, though? What's worth owning in this shelter-in-place economy? Well, it turns out not a lot of the S&P, but we know which ones. So let me give you my stay-at-home buy list, all right? First, there's nothing to do. Doesn't every day feel like Tuesday to you? Doesn't it? In this environment, you want as much entertainment as you can get. There's no sports, but there is Netflix, which is on fire with this. Tiger King. Something came up at the president's show, the press conference the other day. If the pandemic doesn't calm, they may have trouble making new content. But right now, the momentum is here based on prospective signups, and it's extraordinary. Then there are the video games. Activision Blizzard has some hot titles. Take-Two Interactive. Now, that company missed its last quarter. CEO Strauss Zelnick came here, and Strauss committed to making sure that didn't happen again. I like that. No NBA playoffs? How about NBA 2K playoffs? Plus, Take-Two still has Grand Theft Auto, the biggest video game, if not entertainment franchise of all time. They just signed a deal with the NFL to make some non-simulation games, which is good news, even as I have no idea what a non-simulation game is, because I'm getting more and more worried there might not be a season. These new games require powerful hardware. NVIDIA and AMD make the best graphics chips. Both stocks have been roaring. Oh, and the Chinese government may finally be ready to bless NVIDIA's acquisition of Mellanox, which will give them a lot of edge to the red-hot area of edge computing. And by the way, it'll move their stock out. The numbers will go way up the moment that deal closes. Meanwhile, AMD just rolled out some new processors that seem to put them ahead of Intel for a variety of uses. What else is new? I think that they both work here. Once again, AMD's up. Have you seen that? That thing's a horse. Next up, I wouldn't be doing my job, of course, if I didn't mention Amazon. This is the ultimate shelter-in-place stock, which is why it hit an all-time high today. Every time something forces stores to close, Amazon picks up new customers. And COVID-19, the storm of the century. Those people stick with Amazon because it's so darn convenient and it's inexpensive. Now we're realizing that we can buy things online that we used to get regularly from the drugstore. You put your shaving cream, your nutritional supplements, even your toothpaste on auto delivery, and you never have to think about it again. I love it. Plus, their web services division dominates the cloud infrastructure space, something we need more of now than ever because everyone's online. And by the way, the retailers are still flocking to them even though they compete. That's right. They compete with each other. What else? People are ordering a lot of delivery, but they're not too keen on most restaurants because they want contactless delivery. Well, that's Domino's. They figured that out in China. I bet they take this opportunity to wipe out many of their mom-and-pop competitors. I know it's disappointing if you like variety in your pizza, though I have to admit that I like their tomato pie with banana peppers. We know liquor sales are way up. The numbers from Constellation Brands, they were extraordinary. Sure, there are some worries about whether Mexico will make beer an essential industry. Right now, AMLO is really giving everybody a hard time. But Constellation assures us they won't be running out of Modelo or Corona. And don't forget what day is coming up. Cinco de Mayo. I also think the new spiked seltzer could be a very big hit in a warm summer. Added bonus, if you think the November elections will be a Democratic sweep, then you're going to bet they're going to legalize marijuana, also known as cannabis, on Wall Street. Constellation owns a big chunk of Canopy Growth, which already has lots of weed, drinks, edibles ready for sale in Canada. And apparently, they taste well. What would I know? Where will people spend their $1,200 checks for the government? I think they're going to end up at Dollar General. Well, then we're going to go to Walmart and, of course, to Costco. Some of the few retailers that actually work here because they carry all the essentials and their prices are so darn low. We know people are stocking up their pantry with food and snacks. We just got some data, some retail data that shows that Campbell's Soup is doing fabulously. I have preferred Mondelez or PepsiCo for snacking. The latter is Frito-Lay. We recently heard from ConAgra. Remember they told us that the pantry aisle is making a big comeback? They're also killing it in frozen foods. I should mention that Hormel had a very good quarter, and people keep spicing things up with McCormick. I cook with McCormick stuff because I don't really know how to cook, but I know to put it on. How about the home office side of the equation? Like it or not, this is the Zoom of video economy. I know they've taken some security hits, and we had them on last week. Look at their platforms become indispensable. It doesn't have to be for national security. I mean, for instance, I cannot wait till Sunday. You know why? Because Sunday noon is our boozy brunch enabled by Zoom. Now, I was viciously overserved last Sunday, even though I'm living alone. Roku just reported a great quarter. Their platform is the best way to watch all of your favorite streaming services on your TV. I'm on Roku constantly. We need them now more than ever. They were created for this moment. Okay, now let's take a step back and look at what's working outside the home. First, of course, Tesla. The analysts are tripping over each other to recommend this one. Goldman upgraded just today. Big winner in the EV space. I think they're missing the mark. Tesla's simply a rare winner in a sea of losers. It's the auto/technology stock that's safe to own here. Now, if you're starved for income but worry about the safety of the dividend, then look to the companies that just boosted their payouts. We saw some nice dividend boosts yesterday from J&J and Procter & Gamble. Just tonight, Costco. More on those later. Next up, China's making a comeback. And you know what? Alibaba, it's a must-buy. Chinese Amazon doing incredibly well here, and the stock simply refuses to quit. China's open for business, but people are still wary, so they're going to Alibaba. I hope they stop going to wet markets. It's the only Chinese stock I'm recommending. It's the only from China I'm recommending, for that matter. There are a bunch of peripheral names, too. I like Chewy, which lets you order pet food online. The box is there. I love it. Don't have to do a thing. Same thing with Peloton, although my wife still got the clothes hanging on it. What do I know? She moved out to the Hamptons a long time ago. Lulu's on fire. They've nosed out Nike to become my favorite apparel company. Finally, the cybersecurity companies have become a lot more essential in a world where people are working from the less secure computers at home, as we know from Zoom bombing. Here's three of them that I like. I like Okta, Cramer family fave there. Zscaler, a favorite of Heather Gaines, who's in the control room tonight, and CrowdStrike. Maybe I'll put an acronym together for these shelter-in-place winners. Maybe go to @JimCramer on Twitter. Yes, I'm soliciting people. Be chill. @JimCramer on Twitter, and give me some more names that can work in this environment so I can make up not an acronym like FANG, which I created and everybody stole, but an entire sentence out of these stocks. I promise to have it by Monday because I got a lot of time to kill because there's nothing to do. The bottom line, rule number one for the new abnormal is that you stick with the winners and you leave the raggedy rest to the others. Kim in Missouri. Kim.
Booyah from the Shawnee State.
All right, what's going on?
I'm at a 42% losing position on my FedEx holdings. Even if they had a recently announced $140 a share target, I will still not be back to even. Should I sell my position and get into something with a greater upside?
All right, I'll be candid. Like I'm lying on the other time. What does that mean? I'll be candid. I'll be truthful. FedEx is not as good as United Parcel, and I'll tell you why. Because there's a person who runs United Parcel. Her name is Carol Tomei, and she is a genius. So I would say sell FedEx and buy United Parcel. I need to go to Chris in Florida. Chris.
Hey, Chris. Or hey, Jim.
No, you're Chris. I'm Jim. That's all right. Often confused. What's up?
Hey, I have a question on Shake Shack. What are your thoughts on them in the future, how they're doing frozen cook-at-home burgers and drive-thru? You think they're going to come out on top after all this?
No. In the last quarter, the same-store sales weren't that good. I look in the food sector. Food's really hard right now. I like Domino's because they deliver, and I like Wingstop, and I have to bet long-term on McDonald's because of that unbelievable balance sheet. But remember, restaurants Whoa. Let's stay away. Even Darden had to cut the dividend. Let's go to Alex in Florida, please. Alex.
Hey, Jim, how are you? So I have a question about Stitch Fix. I purchased the stock when it was a little over $11, and it's just about $16.
Yeah.
Do you think the stock has the capability of hitting its 52-week high?
I didn't like that
anytime
last
soon?
quarter. Now, a lot of it is just the kind of the malaise, as Jimmy Carr would say, that is brought on by the pandemic. 15, I don't know if it bounces to 17. I mean, anything can bounce. I mean, I'm watching Slack bounce tonight. I think you're going to have to move it because it's not I don't want to say it's a COVID stock. That sounds really just kind of necrological, you know. But it's not something that is the right thing in a pandemic, all right? All right, it's a new world. I need you to stick to the stocks that are doing the things that work during a period of a pandemic because it's very different from the rest of the S&P 500. On Mad Money tonight, as regulators weigh historic oil cuts and oil keeps going down, although it might stabilize here, I'm going to talk to the CEO of Parsley Energy, PE. See why he's pushing for limiting production. Wow. Then in this horrible new world where we have to worry about so many companies' dividends, some are bucking the trend and raising theirs. I'm offering up a list and telling you which to consider. And as the coronavirus is pushing auto dealers to embrace online sales, is it worth considering a company like Carvana? I've got the CEO. So stick with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com. Tomorrow, kick off the trading day with Squawk on the Street. Live from Post 9 at the NYSE.
Jim, you were soliciting acronyms on Twitter. I liked Man Cave from Microsoft, Amazon, NVIDIA, Comcast, AMD, Verizon, Electronic Arts.
That's brilliant.
And, we talked about Amazon.
It all starts at 9 a.m. Eastern.